Hey everyone, Ken McKee here with Canopy Mortgage. Hope you're doing awesome. Hey, real quick before I get started, if you look all the way to the right, way over there, if you hover over the black bar right below me, you'll see a little box like this, like two brackets. Click on it. This will blow up to your entire screen, so it won't look super tiny. Hey, so what I'd like to talk about today is what I see the biggest problem right now with buyers getting into escrow, and it's just a lack of affordability. Not so much that they don't qualify based on loan guidelines. A lot of times they do, but they just don't like the payment. Most people, by and large, are more payment sensitive than they are price of home sensitive. And if you don't believe that, just think back to like 2020, 21, when buyers were making offers on homes that were 20, 50, $100,000 over what they were listed for, and they were willing to make up the difference if the appraisal came in low. And that was just because, by and large, their payments were really low because rates were in the twos or maybe low threes. Now that we're firmly in the sixes, it's a different story, and the payment is the number one driver, not the price. So what most people do if they don't like the payment they have is they ask the seller to do a price reduction. So what I'm going to show is the difference between a price reduction versus using something called a 2-1 buydown. It's a seller paid subsidy that they take a certain amount of money, which is usually around 2.3 to 2.35% of the loan amount, put it in an escrow account for the buyers. So it's a credit from the seller to the buyers. They put that money into an escrow account, or we put it into an escrow account, and it subsidizes the payment for the first 2 years for the buyers, to the effect that the effective rate is 2% lower the first year, 1% lower the second year, and then normal rate from year 3 and on. And the goal would be that within the first 2 years, we will have gone through enough with the cycle of mortgages that rates will have come back down, and to a certain amount of money, point, whether it be in the 4s or 5s, buyers can refinance, get their payment solidly, permanently bought, into the 4s or 5s, wherever we are, instead of 6.625, 6.5, wherever we are today. And so what I'm going to show you is, like, here's just an example of a $700,000 purchase price with a 20% down loan, so just $560,000 at 6.625%. The payment will be $44.14. If you do a $20,000 price reduction, your purchase price goes down to $680,000. The loan amount is 80% of that, so it's $544,000, so $544,000. Same rate, $42.91, and that gives you a savings of $123. So not exactly like earth-shattering or something that would make a buyer want to jump into the house. Versus if the seller, just in this example, takes right at $13,000, gives a credit of $13,000 to the buyer uses that to buy down their rate. We're looking at the same purchase price, same loan amount, but the effective rate is 4.625 the first year. That gives a payment of $37.08, and that is a $706 saving, 6 times more than the price reduction, right at 6 times more. And then year 2, you have 5.625, the effective rate, $4,052, and a $362 savings, and that is roughly 3 times the amount you would get if you just lowered the price of the home. And so cool features here is that, number one, that the buyer is going to save so much money, 6 times about the first year, 3 times about the second year of this $20,000 price reduction. The second thing is that it costs the seller less money. It costs the seller in this scenario $13,000 instead of $20,000. So because it costs them less money, it benefits them. They're more likely to do it. Third thing is the buyer is fixed at 6.625 in this case, but you're fixed at the 30-year fix. It's not going to go up. If you do some kind of a short-term ARM, you're hoping that rates come down. You're doing kind of the same thing, but if rates don't, they go up the other way, then you're stuck. You could be stuck in something that's 2, 3, 4, 5, 6% more than what you started at. And so you're capped. This is a 30-year fixed loan. And fourth is that the buyer gets back any excess funds that are put in that escrow account. So if the buyer is doing this and after 1 year rates fall enough that they say, yep, I'm going to refi, whatever's left in that escrow account goes back to them, either through a principal reduction for the payoff of that loan, or just as a check, like often will be done on an escrow account whenever you refinance and pay off a loan. Whatever's left over in the escrow account, a lot of times you'll just get mailed back a check within 30 days. So if you'd like to look at a personalized a scenario for you or for someone that you know who's either selling a home or buying a home, please give me a call, 916-871-7578, 916-871-7578. Take care. Bye.